Are you building your retirement or the government's? Yes, I know that's a ridiculous statement, but really, are you building your retirement or the government's? I've been doing retirement and estate planning for over 20 years now, and I can tell you that most people are out getting advice not from actual people that know how to play the distribution game, but people who know how to accumulate money. And believe me when I tell you, the distribution game is much more important than how you accumulate money. Don't get me wrong, accumulating money is very important, but most people only think about stocks, bonds, mutual funds, etc. And one of the greatest assets that you can use in your life is actually life insurance. Yet, of the thousands of people that I've taught in seminars and on webinars, et cetera, the one question I always ask them is, do you own life insurance? And they're always going, yeah, I own life insurance. Well, my question would be, well, when do you get paid? And the answer is, when I die. So do you have life insurance or do you have death insurance? Now, I'm going to explain to you and give you an explanation here that hopefully will get you to understand what I really mean by the difference between life insurance and death insurance. And believe me when I tell you, very few people really understand this concept. So this is a 10-minute lesson on life insurance. Let's get started here. Now, when it comes time to buy life insurance, there really only are two ways to do it. You can do it with the minimum amount of premium and buy the most amount of insurance, or you could do it with the maximum amount of premium and buy the least amount of insurance. And you would say, well, why would I want to do that? Well, if I could grow my money tax-free, access up to 85% of it at any time tax-free, put it back if I want, get most of the gains of the market, never participate in the losses, and when I died, it passed on to 2 to 3 times that amount tax-free, wouldn't you want to do that? Well, of course you would. Well, you see, most people, when they buy insurance, they do exactly what they want you to do, and they buy the most amount of insurance using the least amount of money. This is rule, by the way, is set by the insurance company. But if you do it the opposite way, you buy the least amount of insurance using the maximum amount of money. This rule is set by the government. And you've got to ask yourself a question. Why is the government concerned about how much money I put in a life insurance policy? Well, you see, there's an infinite way to design these different products, but there's only one way to design it correctly. So back in the 80s, when they introduced what were called ERISA plans or qualified plans, which was made up of IRAs, 401k, SEPs, 403bs, 457s, TSPs, defined plans, so on and so forth, people weren't putting money in there because they were using life insurance to do this. So the government came out with what they called the MEC limits. And a MEC limit is what's called a modified endowment contract. And what they said is that you had to have a minimum amount of insurance, and there was a maximum amount of money that you could put in that insurance policy each and every year, and that became the MEC limits. Now, if you exceeded the MEC limits, then what happened at that point is you lost all the tax advantages. So once again, I can go out here and I can put as little as $500 in this policy, or I can go out and put in $10,000 in this policy. Now, it would seem that it makes 0 sense to put extra money in the life insurance policy until you understand that I get to grow my money tax-free, access up to 85% at any time tax-free, get most of the gains of the market, never participate in losses, and when I die, it passes on to 2 to 3 times that amount tax-free. So the minimum gets us term insurance, or the maximum amount of death benefit. But if I could go out here and I was looking for the perfect investment, so let's just say I would want to grow my money tax deferred, I'd want tax-free distribution, I want competitive rates of return, I'd like to be able to put in as much as I possibly can, I'd like additional benefits like maybe long-term care, disability, etc. I'd like to be able to collateralize it, use it to go down and leverage my money. I'd like it to be safe. I'd like to have no loss provisions, guaranteed loan option, unstructured loan payments, liquidity use and control, and I'd like to be able to deduct it. Now, what I would call this investment that we're looking at right here is I would call this a unicorn, because this just doesn't exist. As a matter of fact, if we were to compare this to our current plans, our IRAs, 401ks, etc., what we would see is that all of these IRAs, well, we can grow tax deferred, okay? We can certainly get competitive rates of return. We definitely do not have high contribution limits. We're actually limited on how much we have there. There are no additional benefits inside of these things. We can't collateralize IRAs, 401ks, SEPs, 403bs because it's not our money. Is it safe? Well, for the most part, if I was to look at most people's IRAs, 401ks, 403bs, these types of accounts, they're not safe. Now, they'll say something like, well, I have a diversified portfolio. Well, my only question for you is that portfolio, is there any chance that it will lose if the market goes down? Because if it's going to lose, it's not safe. Now, you can make it safe. You could put it in certificates of disappointments, etc. Are there any no loss provisions? Generally not, okay? Is there a guaranteed loan option? Well, I'm going to go ahead and say yes, because if I have a 401k or 403b, I could borrow from that account, okay? I could take up to $50,000 a year. You want to be very careful about taking loans out of your ERISA plans, because something that most people don't know is that if you have a loan out on your 401k and you happen to lose your job, you have exactly 60 days to pay that back. Otherwise, it's considered a distribution, which could be adding insult to injury in that now suddenly you have to pay penalties on that because you took it out early, you have to pay these taxes, etc. Is it liquid use of control? Absolutely not. But I can deduct the money that I put inside of there. So I get a tax deduction. So from my unicorn position, I really don't look very good here, okay? But if I went out here and I bought the least amount of death benefit using the most amount of money, then my benefits would look like this. I would get tax deferred growth. I would be able to distribute that money tax-free. There's three ways to do that: the sad way, the dumb way, and the smart way. I get a competitive rate of return. I have very little limits on how much money I can put in this policy. I would have additional benefits such as long-term care, disability, etc. I could definitely collateralize it. It would be safe, no loss provisions. I'd have guaranteed loan options, unstructured loan payments, meaning that I could take money out of this policy in the form of a loan and never have to pay it back unless I cash it out and or died. And then I would have liquidity, use, and control. Now, what we would call this is not a MEC, but a maximum efficient contract. Now, what does it mean to have a maximum efficient contract? Well, I can tell you that very few people in this country truly understand how to structure a life insurance policy correctly, right down to the people that work inside the insurance companies. It's very difficult to get people to do this and do this right. So if you're going to head down this road, make sure you get the correct guidance and that you're correctly educated. We do have a program on this. We have actually what's called a life insurance mini course, and we'll put a link down to the bottom that you can actually go get this course and take this course to learn more about this stuff. Be sure to subscribe to our YouTube channel. Put some comments down below about what you think. Do you have life insurance? Do you have death insurance? If you could grow your money tax-free, access up to 85% at any time tax-free, put it back if you want, get most of the gains of the market, never participate in losses, and when you die to pass on it 2 to 3 times that amount tax-free, how much would you put in that environment? And my answer, as much as I possibly can. So subscribe to the channel below. Keep smiling. Remember to live like you're going to die tomorrow and plan like you're going to live forever, because you just might. Keep smiling. Make it a great day. Look forward to seeing you soon.